Sales tax is the account that surprises more coaches than the other three in this module combined. Sell only one-to-one coaching sessions, and the question is almost trivial. You probably owe nothing in any state but your own, and even your own state probably exempts what you sell. Add a single online course, a recorded training, a digital workbook, or a paid subscription product to the revenue mix, and the calculation changes hard. The trap is that nobody warns you about the change. You discover it when a state you have never visited sends an audit letter. The surprise this unit prevents has a specific shape. A coach who built her practice around one-to-one work expands into a course product without realizing she just walked into a different tax regime. The coaching business she has been running for 3 years had a simple sales tax answer. The course she launched last month has a complicated one. The two products look similar from inside her business. Both are things people pay her for, but the tax codes treat them as fundamentally different transactions. The audit letter arrives 12 months later from a state she could not pick out on a map. Coaching as a professional service sits in an exempt category in most US states. A 1-hour session over Zoom, a 6-month engagement package, a retainer for an executive. None of it triggers sales tax collection in the typical state. You charge the client, you receive the money, no portion goes to a state Department of Revenue as sales tax. The reason is the way states categorize professional services in their tax codes, which is the same category that covers therapists, attorneys billing hourly, and consultants delivering advisory work. You sit inside that exemption by default. A small number of states tax services more broadly than the norm, and a coach in one of those states cannot rely on the default exemption. Hawaii, New Mexico, South Dakota, West Virginia, and a few others have tax codes that pull services into the taxable base in ways the majority of states do not. The methodology is direct. Call the State Department of Revenue's business line and ask whether coaching services fall inside or outside their definition. 10 minutes on the phone with a real person at the DOR settles the question for as long as you stay in that state. The pivot for course revenue was a 2018 Supreme Court decision called South Dakota versus Wayfair. Before Wayfair, a state could only require sales tax registration from sellers with physical presence inside that state, an office, an employee, an inventory warehouse. After Wayfair, a state can require registration based on economic activity alone. Cross a threshold of dollars or transactions inside the state, and the state has authority to make you register, collect tax from buyers there, and remit it back. Physical presence stopped mattering. Economic-nexus took its place. The typical economic-nexus threshold across states is $100,000 in sales, or 200 transactions in a single state per year. Either trigger registers you. The exact numbers vary state by state, and a small number of states have raised or removed the transaction count trigger entirely. The sales tax decision tree resource carries the current year table for the 10 states where the most coaches live. The point of the threshold is the surprise. A coach in Oregon selling a $50 course can cross the 200 transaction trigger in California without ever setting foot in the state. The distinction between coaching service revenue and course revenue is the single most important line in this unit. Coaching service is exempt in most states, and the obligation tracks the seller's state, not the client's. Course and digital product revenue is taxable in most states, and the obligation tracks the buyer's state. Solo state registration covers the first situation. Multi-state exposure is the realistic scenario for the second once volume grows. The right administration tool is different at the bottom. DIY is fine for service-only sellers and falls apart for course sellers with national reach. Two coaches with identical $85,000 revenue can sit in completely different sales tax situations because of the mix, not the total. Coach A runs the full $85,000 entirely in one-to-one coaching, Ohio-based, clients on Zoom from everywhere. Her sales tax exposure outside Ohio is zero. Coach B splits the same $85,000 as $50,000 in coaching and $35,000 across 900 course transactions to buyers in 38 different states. Coach B has crossed Wayfair Nexus in California and is close in Texas. The income on the tax return looks the same. The compliance picture is unrecognizably different. Coach B's right move is sequenced carefully, and the order matters because registering retroactively in the wrong way makes the exposure worse. Pull transaction reports by buyer state for the 3 years of unregistered history. Identify which years and which states cross the threshold. Before registering in any state where prior year exposure exists, consult a sales tax specialist about voluntary disclosure programs. Most states offer a path that caps look-back periods and waives some penalties for sellers who self-report before being caught. Walking straight into a registration form without that conversation can open the door to full prior year liability. 3 administration paths handle the spectrum of sales tax situations, and matching the path to your situation prevents both overspend and underspend. DIY directly through state portals is fine for a single state seller with modest course volume. You register once, collect manually, file quarterly or annually. TaxJar and Avalara are software products that automate calculation, collection, and remittance across many states at a cost in the range of $19 to $99 a month. The right answer once multi-state course revenue becomes meaningful. A CPA or sales tax specialist enters the picture when historic exposure that predates registration is the problem to solve. Before the next unit, pull 12 months of your revenue and sort it into 4 buckets: pure coaching service, course revenue, digital product revenue, workbooks, recordings, templates, subscription revenue. For every bucket other than pure coaching service, pull a count of transactions and total revenue broken out by buyer state. Flag any state with more than 150 transactions or $75,000 in sales. That is the Nexus conversation you bring to a CPA or a sales tax specialist. If you have 0 course or digital revenue today, save the artifact with a note about the trigger for reopening this unit.